All right, I think we are live. Hello, everyone, and welcome to another edition of the Dividend Power Hour. It's great to be with you. If this is your first time joining, my name is Mark Rushin. I'm a CPA here in the state of California. Those of you that are out there watching already and already getting ready for this edition of the Dividend Power, let me know, where are you tuning in from? That's what we do every single week. Let me know where you're tuning in from and what did you buy or sell in the stock market this week. It is great to be with you guys as always. I see Pat is a first-time viewer here on the Dividend Power Hour. Great to have you there, Pat. And thanks for being in the comment section already. King David wants to know, do you think dividend investing is the way to go? I think it is always the way to go. However, I do not turn a blind eye, and there's a number of different ways to do dividend investing. Some folks like to focus purely on the income. I'm more focused on dividend growth, less focused on yield, more focused on dividend growth, and not turning a blind eye because I do own a number of growth stocks that are actually now dividend stocks. For a while, I've had Meta, I've had Alphabet, both of those non-dividend paying stocks until recently. So, it's good to have a mix overall when it comes to investing. Scott said, I'm leaning that way, Dave. SPYI has gotten my attention. Jackson says, hey, Mark, what's the best ETF to buy right now? Well, we got a couple videos out right now. VIG is one I've been adding to. I had a video out about that on reasons why I like VIG, and I just touched on I like dividend growth. SCHD for years has been a favorite of mine. However, some of the changes that they made recently didn't kind of go along with the type of investing I'm looking for. Doesn't mean I'm selling SCHD, just not as crazy about it right now with a few of the changes. The top two stocks that they took out, Broadcom, AVGO, as well as Merck. Both of those companies historically have solid dividend growth, especially Broadcom, about 17 to 20% dividend growth rate. That's unheard of. What did we replace it with? BMY, very little dividend growth and a falling knife, really. It's a position that I've held for a little piece of for quite some time and a position I'm actually strongly looking to cut the cord on potentially here moving forward. So we'll have to see what's going on there. Jim Bett says, King David, just my opinion, I'd be more worried about Social Security at this point, scheduled to go bust in 2035. Sean Wong tuning in from Singapore. King David, Washington, D.C. Matthew, good to see you, my friend. Vegas, Starbucks, and Vici is on James's buy list, or he did buy. What else? We got Ted tuning in from Maryland. We got Alaska in the house. Lee, good to see you. Hello from Tornado Alley. Hope you're okay there, Matthew, and everyone's all right. Upstate New York for Scott. Alabama for Adam. Bought some QQQM and some SCHD. We got Chicago in the house with Alex. Recently bought some McDonald's. Capital One, Alexandria Real Estate, and sold some Meta. Frequently bought at 430 and sold at 472. So little short-term profits being taken right there. Should you have some precious metals in your opinion? I think that's definitely going to be up to your overall. It's going to be based on your portfolio as a whole. Are you looking more for conservative? For me, I don't really own any. In the past, I've had a little bit of GLD. It's a position I'll go in and out of, so I take the ETF route. I don't own any gold bars. I didn't go to Costco and get my gold bar order in or anything like that. So that's just me right now as it stands. So Emmanuel tuning in from New Jersey, looking at Palantir after the big drop. Catherine's tuning in from Covina, California, not too far from where I'm at here in Orange County, California. Bought some Pfizer yesterday and some ET for tomorrow. Does that mean, Jim, did you already buy the ET or you're looking to buy the ET after the earnings report that had come out today? Curious there. Gretch, good to see you. Matthew did some nibbling on some Net Street and some O, so he went REIT shopping there. And then Drew is tuning in from Minneapolis, Minnesota. Awesome. So let us know. We got 50 people in here just to start. We usually have, well over 100, so people are still rolling in right now. But that is a good start already here on this this Dividend Power Hour. So let me get the slide decks up for you guys. But in the meantime, continue to let me know, did you guys buy anything and where you're tuning in from if you haven't partaken in that yet. But with that, and we'll jump back to those here in a second. Let's jump into our slides to see what has been going on, a quick update on the markets, and we'll be able to jump into our regular scheduled Dividend Power Hour here. So I'm going to get the iPad rolling here as well as the slides. So here we go. So here's our normal slide. If you have joined us on the Dividend Power Hour before, this slide is updated frequently. So we like to look at where are the major indices right now. So we got the Dow Jones up 1.2%, pretty much double where it was last week. S&P 500 is plowing its way towards the top spot, up 9.2%. NASDAQ up 9%. Those are well above where they were. So we got a nice surge in the markets here lately. The Russell 2000 has switched from red down 2% up to green, up 2.5% almost there. So good moves there by the small caps, something you definitely want to see. If those small caps are moving, definitely a very good sign overall in terms of that bull market moving forward. In terms of overall valuation, again, I like to look forward. Investing is less about what you did for me and more about what you're going to do for me. So looking ahead here, S&P 500 based on its earnings estimates from economists out there, sitting right at 20.7. So we dipped below 20 times multiple last week. Now we're with that big move in the market, or decent size up in the market, I should say. It wasn't like massive, but we're at 20.7, well above the historical norms, right there around 17.5 there. So again, looking overvalued to a degree, but lately, the past few days, especially today, we were almost rock solid, right on the S&P 500. Where it opened and where it closed was almost identical. I think it was like 3 cents was the difference. So not something you see in the market all that often. Interest rates have kind of come down a bit. So last week when we had our power hour, we were at 4.64 on the 10-year, down to 4.5 right now. On the 2-year, we were at nearly 5. It touched 5% there. We're at about 4.8% there on the 2-year. So we did get to see interest rates come down, and that has moved our stock market a little higher there. So in terms of earnings season, though, still underway here. We're sitting at about 80% of the S&P 500 has now reported. So we're kind of on the back end, the tail end of the Q1 earnings season, and average earnings growth so far has been about 8.5% when you look across the board. In terms of the Fed decision, we got that last week there, that they're kind of standing pat. They're waiting for more information. And that's exactly what we got at the end of last week with the jobs report. So higher for longer in the near term, but waiting for more information. And we're in that period right now where bad news is good news. We got the jobs report that came out, and not as many jobs were created in the month of April, which normally wouldn't be a great thing. However, that shows that these higher interest rates that we've talked about is slowing the economy. We've seen average hourly earnings come down. We've seen job creation come down. We've seen the number of job openings come down. All of this is starting to play a role to hopefully slow that economy and bring down inflation. So that doesn't completely take off. You know, the last couple of weeks, I should say, we were talking about no more interest rate cuts. No more. We're not going to see any of them here in 2024. I think they're still on the table. And I said that in the past week or so, that it was just 1 month of data that we saw in March. We need to see more. Let's not overreact. Again, it was March data that we were looking at. We still have a lot more months to go where things can change. And lo and behold, here we go. We've seen kind of a consistent slew of reports that are showing, hey, these higher interest rates are definitely starting to take a toll. We're seeing it in earnings as well. When you look at the likes of McDonald's, when you look at the likes of Starbucks and things like that, with the consumer starting to trade down a little bit from that standpoint. However, there are some few reports that I'd like to look at today with you guys, in addition to kind of offset those just slightly there. So bad news is certainly good news when it comes to the stock market right now. Let's jump back over here to comments and let's catch up really fast. So we had Drew checking in from Minnesota. Not Slip from Florida about some Google and some CVS. What are your thoughts on CVS and INTL at these lows? So CVS is one that luckily I got out of quite some time ago. I just think it's a rough business. You know, the majority of their business is going to be pharmaceuticals. There's a lot of competition coming, even with the likes of Amazon and things like that. That, you know, these are big box retailers, big rent that's going to be due from that standpoint. Not crazy about CVS. Is it cheap? Absolutely. But is it one of those stocks that's cheap for a reason? I believe so, in my opinion there. So pays a decent dividend still, even to this point. But, you know, we've kind of seen the likes of Walgreens, which way it's gone. CVS is obviously a much better operator, but not somewhere I want to put, my money right now. All right, Pat. Hi from the UP of Michigan, buying Johnson & Johnson, ONNEE. Jonathan, think a nice rally is underway. We have seen a nice little bounce back, I'd have to say. Naples, Florida, Billy Ray buying some, a lot of REITs to start with here. Agree Realty, Realty Income, Vici Properties, and then we go to some ETFs with SCHD. We got a high yield ETF and VYM. How about some dividend growth and VIG and DGRW? I'm going to say I'm going to go out on a limb and say Billy watches a few of these YouTube videos here because I like all of those. Awesome. So what do we got with Kevin? Howdy. Texas is in the house. Bought some PLD. Jeffrey Hatch. Good to see you, my friend. Washington, but we'll probably have to watch the replay later. Driving to the Suns baseball game. No buys this week. No worries. Thanks for tuning in there, Jeffrey. Hope all is well with you and the family. Meta had a great rally the past couple of days. Did you buy it, Adam? We buy any Meta? Hi from Boston. Bought some ABR. I'm thinking of opening a position in Palantir. Palantir definitely got hit after its earnings there. The economy is slowing. My small business is seeing less and less customers. Curious, Kevin, what kind of business? If you wanted to share it with the group there. Curious to understand what sector you're in and how you're being impacted from the slowing economy. Loading up on SOXL next week. If we go green, NVIDIA earnings will pump the market and tech up. We go as NVIDIA goes. That's really been the tail of the tape for the past 12 to 18 months is the stock market goes the way of NVIDIA. Thoughts on Agree Realty? What's a good entry price? So we'll look at some Agree Realty a little bit later on here, but it is a stock that I like a lot. If you look at its comparables, its makeup today, very similar to that of Realty Income. However, when I look at the top tenants, I actually like the top tenants over with Agree Realty rather than the ones with Realty Income. When you look at Realty Income, you got Walgreens, you have CVS, you got, 7-Eleven is all right from that standpoint. But when you go over to Agree Realty, it's more like Walmart, Tractor Supply, two companies I like a lot from that standpoint there. Definitely not going out of business anytime soon, like Walgreens potentially could, and CVS down the road, who knows, just much slower growing, nothing that excites you overall between those companies there. So I think there's a lot more growth opportunity when it comes to Agree Realty over Realty Income. However, the management is very proven with Realty Income, so it's probably a safer bet overall, but I do like the growth aspects. I own both from that standpoint. All right, Jim, ET was on deck. Haven't done a deep dive on earnings other than it missed GAAP EPS and beat on revenue. Well, again, we don't care as much about GAAP. We want to find that non-GAAP to see what our company's doing on a comparable basis there. So bought some Meta. Adam bought some Meta in the 430s and again in the 440s. Looking good. Long-term Meta there. You were pretty convincing with Prologis. I do love PLD, especially at these levels. I sell Lego pieces online via Bricklink and BrickOwl. We have in my neighborhood here, we have a lot of Lego fans, and I won't get into as big of fans as some of them are, but it seems like they might have a Lego store in their garage at times. Trevon, good to see you, my friend. I bought $100 into PH and $100 into SCHW. So adding some financial exposure there with Schwab, another one that I own a lot. Awesome. Well, thank you guys for the comments so far. We are grooving here on this edition of the Dividend Power Hour. Thank you guys for being so interactive there. So let's keep rolling with the slides. Not much change there in the fear and greed index, even though we saw the market dip, we saw it come back, pretty much staying status quo for the past. This is the third Dividend Power in a row where it's been around 2 percentage points, I should say, from where it was in the prior week. So still firmly in the fear section, sitting at around 41, 39 to 41 has kind of been the range that we've been in when it comes to the fear and greed index. All right. So with that, let's take a look at sector performance. And we're going to jump over to the iPad to take a look at what's going on in terms of sector. We like to do this each and every week and see what are we looking at. So let's go out and look year to date first and see communication services are top one. So think of companies like Alphabet. Think of companies like Meta. Meta was down. Alphabet was up a ton there. So Alphabet helping lead the charge in communication services. Energy still a top sector year to date, up 11%, but right on its heels is information technology, up about 11%. So not much difference between the second and third best performing sectors on the year. And lo and behold, there's utilities, a very defensive sector. So we got energies defensive, utilities defensive, financials can be defensive. Seems like technology has been. So definitely seeing a changing of the guard. And year to date, our only red sector is going to be real estate there, sadly enough, but that's what we want to find. Being a value investors, I'm constantly looking for underperforming sectors, looking for those high quality, because when sectors are down, that can even bring down the best of breed. And that, as long-term investors, we want to invest in high quality positions at great valuations. And that's what we can get right now when it comes to the REIT sector there. So now let's take a look at the 3-month and see how have things been over the past 3 months. Well, lo and behold, utilities, same as we saw last week. Energy, both defensive sectors. Communication services is still up there, but materials is up 10.5%. And then industrials, the only two red sectors in the past 3 months, barely healthcare, but real estate. And the interesting thing is when we talk about healthcare actually had some great earnings. It was, I want to say the percentage I saw was about 90% of the healthcare companies that were reporting in the S&P, within the S&P 500, I should say, the larger healthcare companies beat analyst expectations in this latest quarter. However, a large majority of them are trading below their 50-day moving average. So although the earnings are there, the stock prices haven't quite caught up yet. So definitely could be a sector to look at, especially if you think we're going to be in this consolidation sideways, or if you in fact believe that a pullback is in store. Could be a good sector to find some hidden gems in there when it comes to value. Now let's take a look at the past month, and there we still see utilities holding down the fort. And really, there's only two sectors that are firmly in the green: utilities and consumer staples. Again, both defensive sectors. We're starting to see that trend. We've seen it for 2 weeks now in a row on this Dividend Power Hour, that investors are starting to turn their attention away from risk on and over towards defensive a little bit. It's not a full-fledged, like, let's just move our entire portfolio away from technology and away from those riskier assets. No, it's just probably some trimming and some things that most folks were probably overexposed to particular sectors, and they're looking to rebalance to a degree. So I always like, when I'm working one-on-one with folks that come through my 6-week program, I talk about that, there's 11 different sectors in the S&P 500. We don't need to have equal weightings. There's times to be overweight certain, and there's times to be underweight certain sectors. And you want to be able to understand those sectors. I go through an image that's within my 6-week program, something that I refer back to on a regular basis that shows how the stock market typically moves before the economy does. And it also shows which sectors typically work best in different cycles that we're in. So, definitely want to be mindful of that as you are definitely investing and managing your own portfolio. So taking a further look here at the past month, what's been the worst performing? Well, energy. We've seen oil prices come down a little bit there. So energy is down 5%, real estate down 2.6%, materials and industrials, all of those are down at least 1% or more. Financials kind of right on the cusp there when it comes to sector performance there. So that's a fresh look at where we're at in terms of sector performance. So we've seen, in April, we got that 5% pullback. I know people were freaking out and things like that. However, it was just 5%. That's not a big thing. Usually 1 or 2 times per year, we usually get a correction, which the definition of a correction is about a 10% pullback. And those are healthy. Those are healthy for bull markets. You want things to reset so that we can further push higher. It's all part of the cycle there. And that's why you don't want to get emotional during those pullbacks. Right now, we're kind of in a consolidation period where we've seen kind of the market trading sideways here for the past few days, at least, which is another form of the form of consolidation. We don't necessarily have to see the correction, but we need to see a reset. So I think most of us would agree that we would much rather take the consolidation where the markets trade sideways, which allows earnings to catch up, because you can't just keep buying and the stock price going up without earnings catching up. Otherwise, valuations don't make sense at all from that standpoint there. So, it's good what we're going through right now. Could we see a pullback? Absolutely, but we'll have to wait and see from that standpoint there. So, all right. Let me take this moment here while we got you to tell you about a REIT workshop. We've talked about real estate. We've talked about real estate investment trust in particular. I just opened up registration for our REIT workshop. You may have gotten an email yesterday. If you are on our list, it'll be May 16th. So not this Thursday, but next Thursday at 8 p.m. Eastern time. We're going to be diving into everything REITs during this workshop here. Why should you invest in REITs? What are REITs? How can I utilize these and put these to work in my portfolio? And then most importantly, what most folks are going to come for is how do you analyze REITs and how do we value REITs? And then we'll also have a Q&A session with my good friend, Brad Thomas, who is an expert in the field. He has been covering REITs for a number of years, decades per se. And you can see that REIT book right over my left shoulder here. Brad actually wrote that particular book there, and a number of other books that are custom and focused on REITs there. So hopefully I'll throw that screen back up there, or that slide back up on the screen so you can see. But there's a link down in the description below if you are interested in getting some more information on our REIT workshop. So if it's brand new to you, or if you're interested in understanding how to analyze and how to value REITs, because it's very different from analyzing a company like Apple, Nvidia, Google, Johnson & Johnson, AbbVie, whatever it may be. REITs are a different animal. There's different accounting guidance they have to go through and things like that. And in addition, we're going to take a look at what I believe are 10 of the best REITs to invest in. Again, this is a sector that has been beaten down, a worse performing sector. But as a long-term investor, knowing what's on the horizon, rate cuts, you're going to be looking back in 12 to 24 months. And I believe this period of accumulation that we're in right now, just accumulating shares, not backing up the truck, adding here and there to high quality names, we're all going to say, I wish I added more. I wish I bought more of that REIT. I wish I bought more of that REIT. So definitely, if you're interested in REITs at all, whether you're brand new to REITs or you have a little bit of an understanding, definitely check out that REIT workshop. Next Thursday, 8 p.m. Eastern time. We'll be doing it live and going through a number of different activities that'll help you along the way with analyzing and valuing REITs. And I think that Q&A session is going to be quite useful as well, bringing Brad on, who is, an expert in the field. And Brad and I have worked together for a number of years now. So he's a great person and a great addition to have on to that workshop. I think it's worth it just attending for that session, that piece of the workshop right there. All right, so let's have a little fun now. And let's play a little of what would you rather? Which stock would you rather own? So I'm going to show you a couple of different metrics here. I'm not going to give you all the information per se, but we're going to give you some information. So we got 3 different stocks. We got stock A, stock B, and stock C. You're going to see the revenue growth, which is -1% for stock A. You're going to see stock B with revenue growth of 12% and stock C with revenue growth of 13%. Then we have free cash flow margin. So for those of you unaware what free cash flow margin is, free cash flow is what runs the show. Free cash flow is how the dividend grows. That's one of the most important metrics that I look at when analyzing a particular stock, whether we're talking about a growth stock or a dividend stock. Free cash flow is where dividends are paid from. Free cash flow is where debt is paid from. Free cash flow is where stock buybacks happen. So free cash flow is an important thing. When we look at margin, that's telling us what percentage of every dollar that we sell in revenue, what percentage is that being turned into when it comes to free cash flow. So looking back here, we got free cash flow margin of stock A at 27%. Free cash flow margin for stock B, little less at 22%. And stock C is at 3%. And then we got forward PE multiples, 27.7 for stock A, 22.4 PE multiple for stock B, and an 18.1 times multiple when it comes to stock C. So first question, which of these stocks would you rather own right now? If you could only buy one of them, let me know in the comments section, which stock would you rather buy right now? Would it be stock A? Not much in terms of revenue growth, but strong free cash flow margin, higher multiple. Is it going to be revenue? Is it going to be stock B with stronger revenue growth, high free cash flow margin, and a cheaper valuation? Or is it going to be stock C, which has roughly the same, but the fastest revenue growth, lower free cash flow margin, but also the lowest PE multiple of the 3 here? So what do we got in the comments section? B, 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 B. Everyone wants B. No one's going to go out on a limb. James is going a lot of B. He's buying a lot of B. All right. So B is the clear winner right now. Now I want you to tell me which stocks do you think these are? These are only going to be large cap companies here. So which do you think stock A is? Which do you think stock B is? And what do you think stock C is? And I'll give you a clue. They all pay dividends. All 3 of these companies pay dividends. So that'll get out some of the companies that you may think they are right now. So all 3 of them pay dividends. And they all pay dividends less than 1.5%, we'll call it. Let me confirm that real quick. Yep, 1.5% or less, all 3 of them right now. So what do you think stock A is? What do you think stock B is? And what do you think stock C is? Just throw out a guess. So Ronald's going to go Johnson & Johnson for stock A. Nor is going to go UHN, or is that UNH? UNH for C, the forward PE is under 20. Yep, that is correct there. All right, you keep guessing. I'm going to show you slowly but surely what these are. So UNH is B. Okay, that's a guess there. So UNH. I will tell you UNH is one of the stocks. So that was a great guess there. Stock A is Verizon, Billy said. Okay. James is going stock A is Microsoft, B is Apple, and C is Meta. I would love Microsoft at a 27 times multiple. I would love Microsoft at a 22 times multiple, Brett. So Apple and Meta for stock A and B. A is Starbucks for Kevin. Awesome. These are great. What we got a couple right so far. So let's take a look at the first one. So stock A, -1% growth. That's definitely not Microsoft. 27% free cash flow margins. That's very solid from that standpoint. And a 27.7 times multiple. This multiple actually was much higher, well over 30 for quite some time, but the stock has come back in, but had a nice little bounce of late. So what stock is this? Might it be? There we go. So stock A is Apple. Apple revenue growth has gone nowhere. If you look at EPS growth, it's been climbing. Why has it been climbing? Because they've been putting $90 billion in stock buybacks the past 2 years. And now would they come and announce $110 billion? So if you have net income, that's roughly the same for the past 3 years, but you're dividing by less shares outstanding. Yeah, your EPS is going to grow inorganically from that standpoint there. So it's a good way to return money to shareholders, but you also want to look at it from both angles and say, is the EPS actually growing? Is this company making more money? The answer has been no when it comes to Apple. But again, forward looking, is the AI phone, do you believe this AI phone and all the services revenue is going to continue to grow? Then you want to take a closer look at Apple. So that is stock A. What were our guesses for stock B? I think we had a UNH was stock B for one. I think we had a Starbucks for one as well, CRM and Tesla. So here we go. Let's take a look at stock B, which is Alphabet. So that's my largest individual holding right there. And I kind of tricked you to a degree saying all of these companies were dividend paying stocks. Well, Alphabet is a dividend paying stock now. Not much. Again, I said they were, all the yields are below 1.5% or below. And that's where Alphabet is. Not much in terms of yield, and neither is Apple. So much higher in terms of revenue growth with Google compared to Apple. Free cash flow margin, slightly less than Apple there, but the yield also. This is a company that you've heard me talk about in other videos. You've heard me talk about in the Dividend Power Hour, is a company that, doesn't get enough credit for what it deserves. It's got cloud. It even has the hardware component. It's got software component, and it has the top 2 search engines in the world with Google search as well as YouTube, where most of you are watching this right this instant, this live show here. So, it's got a lot of irons in the fire, and that's just mentioning a few of them right here. And I also think they have a big growth channel moving forward with AI. Microsoft bought into AI. Google and Alphabet are creating their own AI. They're going to have a lot more influence because they own it entirely. Alphabet bought into it, Microsoft bought into it. Alphabet's building it. I give them a lot more props from that standpoint there, and I think they can do a lot of things, and they haven't had that AI sprinkle dust around it to where if you mention AI, boom, your stock takes off. If you just mention it inside of the earnings call, your stock takes off. At 22 times earnings with the report that they just put out, even with the stock jumping, I still think it's a great valuation from that standpoint there. And I'm happy to say it's my largest individual holding there. So love me some Alphabet. So we got Apple, Alphabet, and we got some guesses on C there. It looks like Jim Betts is going to go with Coca-Cola. Not is going to go with UNH. What else we got? Another UNH there. Yep, definitely not Tesla, the iPad company. CRM was a guess as well. So here we go. This might be the only one. I think you guys got it right. Bang, UNH, United Health Group here. So again, if you're looking for a company that regularly grows its dividend and has faster dividend growth, UNH is a great one to look at. But they also can compare favorably on some of these levels here. Look at the revenue growth, faster than the other 2 companies, which are mega cap companies. However, the free cash flow margin isn't quite as high. That's very low there from that standpoint. However, you do get a break in the multiple, largely because of the lower margins from that standpoint. But I think if we go through this period of stagflation, insurance businesses can be a great spot to look at. So UNH and even a Berkshire. Berkshire's like investing in a mini ETF in itself. Actually, not even that mini at all. I shouldn't even use the word mini. It is like an ETF. Doesn't pay a dividend at all, but it's kind of like an Apple-focused ETF. So if Apple was your largest position, Berkshire might not be one that you want to build a big position in because you're going to have a ton of overlap. It's almost 50% of its portfolio. I know they reduced their exposure in Apple recently when Buffett had talked about that, but just for tax reasons is what he told us there as it pertains to that. So that was a fun little game from that standpoint. Let's dive back over to the iPad and take a look at what's going on more in the markets that we are going to talk about. So let's look at a few REITs here. When I talk about REITs are down and out, we're getting some big time valuations. So a few that we're going to look at right now is going to be Realty Income, probably the most popular REIT on the market, or at least the most well-known REIT that's on the market out there today. So Realty Income, also known as the monthly dividend paying company. You can see right now they traded about $55 per share. In terms of what are analysts expecting over the next 12 months, we can see $4.17 AFFO. So when it comes to REITs, remember I told you it's going to be a little bit different. We don't want to focus on earnings per share like we do with Apple, like we do with Google, or like we do with United Health and things like that. REITs are going to be a very different animal from that standpoint. And we're going to look at how we can evaluate and what do we compare to. So you can see this blue line up here is kind of where the stock normally trades. This is normal valuation. Realty Income's down there. So definitely some big time discounts when it comes to REITs. What's another popular one? How about PLD? PLD, you heard me in a couple of recent videos I did. I just like it that much right here. So PLD, you can see the big slump that it had right there in the recent days, but trading well below its historical average. And we're going to show you exactly how to calculate all that within the REIT Workshop. And if you're just joining, we have a REIT Workshop next Thursday, 5 p.m. Pacific, 8 p.m. Eastern time. You could check out the link down in the description below. We just opened registration, so you can start and click on that link just to find more information. And if you're ready to claim a spot, it's going to be a very intimate group. We're not opening this up to 100 people or anything like that. It's going to be a very intimate group because we are going to be doing that Q&A session with Brad. So we just have a very few number of spots that we will be opening up. So if you are interested, definitely sign up for that as quickly as possible there if you know you want to take it. So those are REITs. Let's take a look at what kind of fueled the market last Friday. So the day or 2 days, I should say, after our latest power hour, we had the jobs market come out. And it's been this tale where bad news is good news. Less jobs, you're kind of rooting against the U.S. economy if you want less jobs. But that's something the Federal Reserve needs to see right now to show that, hey, we don't need to keep rates higher for longer. It is working. And we might, in fact, be able to cut rates later in the year, whether it's the fall or whether it is winter time, right around the holidays towards the end of the year. However, they probably don't want to do anything in particular around the election from that standpoint, which will be in November. So maybe we get something in December right now. So, I think you can't really price out all rate cuts for the time being right now because we are starting to get some of the information that we're looking for. I mentioned it early on. Consumer data starting to look much weaker. We're starting to see less and less jobs growth. What do we have? We had jobs growth of 175,000. A decent little number there overall. But what were we expecting? We were expecting 240,000 jobs added in the month of April. 175, that's a big miss. Stock market said, oh, awesome. We won't get any more rate hikes. We might not be in the higher for longer as long as maybe we started to think we were moving forward. How about unemployment, which has been, very low, down around 3.5%? That has slowly started to creep higher and higher. 3.9%. Expectations wanted it to stay right at 3.8%. So that creeped a little bit. And again, no one's rooting for someone to lose their job. However, the stock market says, woo, let's go. We're going to have interest rate cuts on the horizon here. So we know how fast the tables can turn with investors believing rate cuts are coming. Remember, we started the year thinking that we were going to get 6 interest rate cuts, which we've discussed enough on this channel that was just, far-fetched wishes from that standpoint. But did we think coming in that we might get 2 to 3? Absolutely. What camp am I in right now? Probably closer to 1, but I'm not taking any of those completely off the table, as I've mentioned there. So, you definitely want it to keep looking at those from that standpoint there. So you also want to look at the jobs report and see where it's coming from. Is the government just supplying a lot of these jobs from that standpoint? How can you tell? Well, you can see what government jobs are being added. Healthcare has been the leader there in terms of 57 or 56, I apologize, 6,000 with healthcare related. Other sectors showing big increases, social assistance, more government from that standpoint. And then transportation and warehousing there. So usually if we see the transportation sector doing well, that's usually a good sign that the economy is doing well. That's usually going to be your first sign that the economy is headed towards a recession, is when transportations start to slow down. Because if people start pulling back on orders, truckers don't have to drive as much. So that can be a very early sign that things are going bad. However, if they're having to hire more and they're getting more business, that's a sign that the economy's not all that bad right there. So, there's multiple ways to look at it from that standpoint. So here's a couple charts that we can look at in terms of the monthly job creation. So we could see that April one was pretty much the lowest we have seen since October, which if we revert back to the stock market in October, that was actually the lows, the last low point that we saw in the stock market. Stocks shot up since that Halloween period, really, in October of 2023. If we scroll a little bit further down here, though, you could see the unemployment rate that started up at over 6% there in January of 2021. It has cratered, due in large part to a lot of the pandemic-related jobs that we had, so on and so forth. Those have been flushed out, and we're kind of at this full employment rate. But things were below 3.5% back in January 2023, April 2023. Then we started creeping higher and higher as we go, slowly but surely. Still very low, nothing to be concerned about, but it's starting to show some cracks. And you don't want to be in the wrong position with your portfolio too late. You want to always be looking ahead. What is the economy showing me moving ahead? If we get 4%, 4.1% in the next job report, you probably want to start positioning your portfolio to get a little bit more defensive from that standpoint, just to a degree. Again, we don't need to take risk off and sound alarm bells or anything like that. You just want to be active from a portfolio management perspective from that standpoint. The other concern that we've seen, and we've talked about a number of them already, how about average hourly earnings? Year over year, average hourly earnings at the start of 2022, we're growing at about 6%. Fast forward to today, we're at our low point that we've seen in the past few years at just 3.9%. People are making less and less money. If inflation remains high and people are getting less and less raises and making less and less money, not going to bode well for the economy. We already are seeing the lower income consumers push back on some of these price hikes. We saw it with McDonald's. We saw it with Starbucks. We didn't see it, though, with Dutch Brothers, which is a competitor, a much smaller competitor to the likes of Starbucks. However, it's a much different type of consumer. Very sugary drinks. I don't know if you've ever been to a Dutch Brothers before. I've been to a couple when I go travel out in the Arizona area. They're good to stop by. The cold brew is fine. But if you look at their menu, 95% of their menu probably has 1,000 grams of sugar in each of those drinks there. I've tried a few of them. I have young kids, tried a few of them. I will say they're good, but they will get you on a sugar high from that standpoint. I don't know if any of you have ever tried a Dutch Brothers and what your thoughts are. I was in my Discord community today asking folks what their thoughts were on Dutch Brothers, and some of them, especially over in I think it was Oregon. I had a member that was explaining to me how that's kind of where it started, and they've been so busy that they had to actually change locations because of how busy. They weren't closing locations because of those locations were dead. They were overly busy that they had to change locations to get a larger, better suited location there. So Dutch Brothers saw some strong same store sales growth and things like that. So definitely a stock to keep an eye on. Is it one quarter? Yeah, we never want to overreact to one specific quarter, but it was kind of the complete opposite from what we saw when it came to Starbucks, which reported one of its worst quarters ever, especially since I've been covering the company, which has been a number of years from that standpoint there. So, definitely some things to be mindful of, to be concerned about in the overall economy from that standpoint. So now let's take a look at something we didn't get a chance to look at last week just because of timing, which was Apple. So Apple reported earnings last week that beat analyst expectations on both the top and bottom line. As we could see here, they reported GAAP EPS of $1.53. Let's get this in here. $1.53, but beat by only 3 cents, so not a big beat there. Revenue came in at $90.8 billion, which was negative 4.3% year over year for that particular quarter, and they beat by 190 million. So they slid by in terms of analyst expectations there. The board did declare a higher cash, but look at this, a new $110 billion share repurchase program. That's a lot of dough. That is a lot of cash right there. This company has a hoard of cash. I mean, you could go down the list and look at companies that don't even have market caps that big. Apple's buying back their own stock. They can go and buy multiple companies all at once. It's not just one or the other. They can go buy multiple companies with that type of cash there. So Apple reported a solid overall earnings there, what they're doing with their cash, putting it to work. They talked a lot more about AI. It's something that they've been a little bit more reserved on moving forward. So, we'll be set to see, is this going to spark that handheld device sales? The chip sector has kind of been divided per se of late. Chips has kind of been that one sector that just is can't be beat. However, as you start to look a little bit closer, it's not all chips are working anymore. AI related chips, those are the companies that have been working. If you're involved in other things like PCs and stuff like that, hasn't been as easy of a road there. We saw that with AMD. We're going to see what NVIDIA has coming out here soon. So definitely things you want to be mindful of moving forward is we're not seeing all, SMH in general just continuously working from that standpoint there. So we had a question earlier in terms of Warren Buffett. So I thought it'd be useful to bring up his portfolio to see where does he stand right now on his top positions. So you can use this site. This is called Hedge Flow, but this kind of essentially tracks a lot of the top and the largest hedge funds that are out there. And you can kind of see their latest updates when they put out their 13F filings and things like that. So we got word lately that, Berkshire declined and sold some of its Apple, about 13% of its Apple. So we're going to see those that update once they release that. But in terms of his largest holdings, in terms of the weighting of the overall portfolio, Apple accounts for 50%. It's going to drop below that here in the near term. So right now, as we speak, it's going to be less than 50%. This is as of 12/31. You got Bank of America, you got American Express, Coca-Cola, Chevron, Occidental, which that's just going to be the equity portion of Occidental, Kraft Heinz, and then Moody's. So those are the top positions when it comes to Warren Buffett. How many of those, what is that? 1, 2, 3, 4, 5, 6, 8 companies do you have in common with Warren Buffett over in your portfolio? Let me know down in the comments section there. So one more look before we roll on. Apple, Bank of America, American Express, Coca-Cola, Chevron, Occidental, Kraft Heinz, and Moody. Let me know how many companies you share. I have, what do I got? Apple, Bank of America, Coca-Cola. So I share 3 of them. I have some through obviously ETFs, but I share 3 individual holdings with Buffett's top ones there. We've also, we heard about Buffett starting to decrease exposure to some equities, mainly Apple. Apple, there was word that I think it was 13% is what he sold. He said they were just for tax purposes. It wasn't because the stock was overvalued or he had concerns about it moving forward, just for tax purposes. I think that's, some baloney mixed in because he doesn't want to spook investors. If the great Warren Buffett is selling Apple, do you know how many people just copy his trades and go and sell it just blindly? He doesn't want that because he still owns 40+% of his portfolio in the stock. So, he wants to make it sound a little bit better from that standpoint. So let me switch over to the comment section here just to see how many of you guys share some common stocks, some top stocks with the great Warren Buffett there. What do we got? So Jim's got Coke and just sold out of Kraft Heinz. So only down to 1 there. So no Apple for Jim. Jordan's got just BRKB. So I guess you share all of the positions with Warren Buffett since you own his. 4 similar for Bubble. Only Apple for Torres. Manuel's got 2. Nick for Apple. Chuck. Warren owned 6%. Mike B's got Apple, Bank of America, and then obviously some ETF exposure there as well. Awesome. So not only did we get in the past week or so, or the past just few days, did we get word of some large hedge funds, some large big time investors trimming some stocks. It makes sense. We have an overvaluation. We have stocks that have been on an insane run that usually doesn't typically happen all that much. So as a portfolio manager, you never lost money taking profits. Never be scared to take profits. So, if you're doing your due diligence, if you look at valuation, it's overextended or it's over, you want to have a reason on why. You don't want to just sell if you're up $5 or something like that. If you are up meaningful money and you have, a large amount of shares, why not take some of your original investment off and play with house money? Those are things that you can definitely think about doing. First and foremost, I'm a long-term investor, but I have different rules that I live by. One of those being that I don't want to see an individual stock holding grow to be more than 8 or 10% of my overall portfolio. So if Nvidia grows so much that it's now 15% of my portfolio, sure, when it's at all-time highs, I might trim a little bit to bring that down, to rebalance it. ETF managers do it all the time. Portfolio managers do it all the time. So I should probably do it all the time as well from that standpoint there. So but Buffett wasn't the only one. So I wanted to make you aware of that. Let's bring up a couple other ones that I'm going to show you guys right here. This is another investor I like to follow a lot, Brad Gerstner. He had an instrumental role in what Meta did. He wrote Mark Zuckerberg a personal open letter back at the start of 2023, which pretty much sparked the year of efficiency for Meta and the huge run that we have. You could attest and compliment a lot of thanks to Brad Gerstner. Now, of course, he doesn't pull the strings or anything like that, but he definitely made it clear from that standpoint. And as you could see here from this, we won't read the article right here, but he's pulling back some of his positions. I think he said about 1,000 basis points. He has gone, number one, he's gone short some positions, and he has trimmed some of his long positions that he has big time profits in. Not the only one. How about Stanley Druckenmiller? Another very notable, very large investor in terms of, overall, not saying large in terms of the human being, large in terms of cash and the money that he manages. He trimmed Nvidia. I know that's like a sin these days in the investing world, but you never lost money taking profits. If you're taking profits at 950 when a stock you bought at 200, it makes sense. You can't, because if you look back at 2022, Nvidia was a stock that was down 75%. Take profits sometimes. It's okay, folks. So, if they're sizable, if you're up 5 or 10%, probably not worth taking profits there. But when I'm up, a 5-bagger or a 2-bagger or something like that, where I'm up, a good portion, sure, I'll take some profits from that standpoint there. So even Gerstner, even Buffett are taking profits in stocks. Looking at S&P 500 that we stopped at almost 21 times. Historically, it's at 17. Looking at those individual stocks trading well above their 5-year averages. Looking at different metrics, all of which we look at within my 6-week investing accelerator course as well. All of those things add up. And if they say sell, we're looking at profits. Let's take a little cash here from that standpoint there. So it's okay to take a little cash there. So with that being said, any questions that you guys have right off the bat, any stocks in particular, we'll do it for a few minutes that you want to look at some valuations or just kind of get my take on. I want to leave the past few minutes here to hear from you guys. I've talked a lot about the information that we had set for today's Power Hour. I hope you guys enjoyed the information that we went through. But I will leave the floor to you guys if you wanted to discuss any particular stocks or ETFs individually that you would like to look at. Feel free to drop those in the comment section. And one more time, if you are just joining us and are interested, we do, in fact, have a REIT workshop that'll be next Thursday, May 16th. So we'll have one more Dividend Power Hour to tell you guys about that. But there are only a limited number of spots. You'll be learning what are REITs? Why should we invest in REITs? How do we analyze REITs? How do we, more importantly, value REITs? And probably a section you'll like the most is, what do I believe are the top 10 best REITs to buy right now? Not only will we list those out, but we'll also take a look at those valuations. So it'll be interactive from that standpoint. We'll have information. We'll have work for you guys to do as well so that you can get some practice. And then very importantly, we're going to have a Q&A session with the great Brad Thomas, who is an expert. And when I mean expert, it is very difficult. I would pretty much have anyone go out there and say, can you find me someone that's more in tune with the real estate investment trust world than Brad Thomas. He goes out and speaks with CEOs on a regular basis, traveling around the U.S. To talk. So he's a good friend of mine, and he's nice enough to join us for next week's workshop. I think that's really worth the price of admission right there. But you can check out the link down in the description below if you want to join us for that intimate REIT workshop that we have there. So, all right, what's our first one there? Waste management. So let's take a look at a little waste management. So let me pull up waste management. So when we're doing this part, you'll have to bear with me, as you know, obviously I don't have anything up from that standpoint. So we got waste management here. Let's look at what the stock has done. Waste management is a trash stock. It's a joke I always like to tell. Hopefully some of you chuckled in the background. All right, so waste management, you're going to get you're trading at 28.8 PE, getting a dividend of about $3 per share, yield 1.4. Nothing crazy in terms of the overall yield. Let's take a look at dividend growth, about 8.5%. They've increased their dividend for 20 consecutive years. Low payout ratio, looking at it from that standpoint there. What are we compared to? So normally we trade at about a 28 times, so fairly valued from a PE type multiple there. Undervalued from EV to EBITDA. How about a price to free cash flow? About fairly valued. So I'm not seeing anything that's showing me that this stock is screaming undervalued. Again, this is quick analysis from that standpoint there. So we got a stock trading at 210. What's our growth here moving forward? 210. We got $7.30 in EPS moving. So we're at 28.7 times there. Historically, we're right at 28.7. So this one's just kind of screaming. It's not a big discount. It's not overvalued. It's sitting right where it historically, where investors have historically bought it at. So again, I don't like to buy stocks at fair value. I like to find companies, high quality companies, trading at cheap valuations. That's why I believe the REIT sector is going to be one that, you know, you're going to want to build a position into, understand how to evaluate them from that standpoint, because it's very different, REITs versus non-REITs. You know, I like ETFs. You've heard me talk about it a lot. I love investing in ETFs, not when it comes to REITs. There's such a wide variety of REITs. You got the MPWs of the world, which is just, you know, to not put it lightly, but just a horribly run company, in my opinion. I think they've just burned cash. I don't think they've diversified enough. I just think it's a very poorly run company. It's a reason the stock price has gone from 30 down to 5. But then you have more of the realty incomes, but they're both down big time. You have the PLDs down big time. You have public storage down big time. All of these companies, unless you're a data center REIT, are really down over the past 12 to 18 months due to higher interest rates. So, you know, definitely something to be mindful of. But that's kind of my 2 cents when it comes to waste management there. So what else we got here? WP Carey was another one that I bounced out of. I just think there's a lot better options out there. So when they cut their dividend, that kind of took a lot of people by surprise. Hopefully it's helping out. Not one I've looked at all that much lately there. So what other? Not familiar with MSOS. Looking into CAT to get into industrials. Seem like construction never ends. So Jordan, construction is always out there, but it is very cyclical business. So if the economy slows down, you're going to expect a lot of those budgets, a lot of those things that are moving forward to say, hey, can we slow down? Because they usually don't pay for them up front. They pay them periodically over time as work is being performed. But if we start to see a slower economy, if you expect that, expect construction, expect industrials to be a sector that could potentially slow down. When the economy is bottoming out and getting ready for a boom, that's a sector you want to get into at that point. So if you don't think a slowdown is coming, and I'm not saying we're going one way or the other, but if you think that, hey, we're just in this period of consolidation, we're going to get off to the races here in a month or so or a few months, then yeah, industrials could be a sector to definitely look at. And the two largest there that I both like are Caterpillar as well as Deere, which gives you a little bit more in terms of agriculture. It also gives you kind of that, I don't want to say Tesla because I'm not a big fan of Tesla, but that self-driving type tractor software piece that they're putting into a lot of their machines that could be very beneficial for farmers down the road there. Dragon, awesome. There should be a link down in the description below. There's a 7-day free trial if you guys ever do want to join our newsletter. You can try and become an Edge Plus member. So I'll jump ahead to that right here. You can see you can join for free, and you can get our weekly wrap-ups, our midweek. You also get, if you are an Edge Plus member, you get access to my portfolio. So I just dropped my latest portfolio. It's actually multiple portfolios, not just mine, but there's others that help me there. So my team, we post a number of different portfolios there. We do that once a month, give you a portfolio update. But if you are part of our Discord community, you get up to the minute any stocks and options that I am trading in my portfolio. You do get access to those. We do our top stocks to watch list items that go out there, as well as our weekly Edge report, which is much more in detail, hoping to give you an edge in the market and help you be more well-informed. We want to make this a one-stop shop, not where you have to go to 5 different websites to find a bunch of different information. We're trying to compile and pull all of that information together in this one newsletter. So that's the Stock Investors Edge that you can join. And there should be a link down in the description below where you can try out and become an Edge Plus member for free for 7 days and see if you like it. Quentin, thank you for joining. Yeah, send me an email, Dragon. If it didn't work, just feel free to send me an email, mark@russinfinancial.com, and we will get you all set up. Tomas, they reported earnings that looked pretty good. I briefly saw them after hours. I was preparing for this, so I didn't get to dive deep into ET at all. But when I quickly looked, the EPS, slight miss there, but they beat on the revenues with 14% year-over-year revenue growth there. So I'll have to take a deeper dive to see what those are. But I think Jim Betts was on the show here and took a quick look at that and did like what he saw there. So Chipotle is an expensive one. So let's take a look at Chipotle. Love to eat there. Just did Kava as well recently. I don't own either of them. So let's look at CMG, Chipotle Mexican Grill. We could see, look at this growth that's coming forward here. So there we go. So we got 24% growth expected this year, 21 next year, and 19. So we're starting to slow growth. That's nothing to be concerned about overall. Historically, we traded about a 47 times multiple from that standpoint over a 5-year period, or 59 times, I should say. I keep moving the graph there. So I think the stock is priced to perfection. It's hard comps to try and beat. I think it's trading at a premium right now and does, in fact, need to come back in. A stock trading at 60 times multiple with 24% growth. It's a bit of a disconnect there overall. So I'd like to see Chipotle come back. It's kind of had a parabolic type of run, an NVIDIA type of run since the end of 2022 there. So, or I should say 2023 since October. That's not a stock that I have in my portfolio, nor is it a stock I'm looking to add in my portfolio right now. Scott T, SPYI. It's fairly new. Your take. Let's take a look. SPYI is a high income. So it's the NEOS high income. I've done a video on this one before. So they are new. I like to usually see a little bit more in terms of data, what we're going to get in terms of return. So yield's been about 12% there overall. When I looked at the overall strategy, it was one of those income-based strategy derivatives, I should say. So think of the likes of, although it's not exactly comparable, but think of the likes of JEPQ, JEPE, and things like that. There's a lot of those types of ETFs that have come in the market. So just be mindful that it can cap your upside there overall based on the strategy that they utilize there. Cat is a mass-producing dessert. Not cat gold, color heavy equipment again. Rebuild is always needed. It's definitely something that's always going to be needed from that standpoint. So it's safe and reliable, but you can expect different periods, different patterns that stocks and companies like that go through. Hershey's, that's a good one. So Hershey's I like. I think it's cheap, but it's also one of those stocks that's cheap for a reason. You want to be in that accumulation phase and don't expect a ton right now. Why? Because the cocoa prices have just skyrocketed. Really bad weather. But again, that's a short term. So I'm looking for, if there's stocks that fall because businesses are broken, that's one thing. But if stocks fall because there's a short term, near term issue, that's another thing. That's something that says, hey, once this issue gets out of the way, this stock's going to be off to the races. Those are the ones I want to buy. Those are constantly what I'm looking to buy. And that's exactly what the REIT world is doing right now. The REIT industry, all REITs are down. You have your pick of the poison on high quality ones. So, you want to make sure you're focusing only on high quality ones, because there's a lot of bad ones out there. And that's why I don't invest in REIT ETFs myself personally. So that brings us up to the top of the hour there, folks. Thank you guys so much for being an interactive group. I hope you guys enjoyed today's show. And if you haven't done so, make sure you smash that subscribe button down there. Hit that like button as well. And don't forget about that REIT workshop that we have coming. Not this week, next week. It'll be May 16th. You can see a link down in the description below. Get yourself some more information. Save yourself a seat to hear Brad Thomas, myself, learn how to evaluate REITs, how to go through and analyze REITs to find the best ones for your portfolio, and why you should be investing in them right now. So thanks again for joining. I appreciate all of you and all the support you've given me over the years, and we'll see you in the next one. Take care.